Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Intercontinental Exchange Inc. quarterly report. Intercontinental Exchange Inc. provides a wide range of businesses and services to various entities worldwide. These include exchanges, regulated marketplace technology for listing, trading, and clearing derivatives contracts and financial securities data services. Data and connectivity services related to exchanges and clearinghouses, fixed income services, fixed income pricing, reference data, indices, analytics, and execution services, global CDS clearing. Global Credit Default Swap, CDS, clearing services, multi-asset class data delivery technology, delivery of multi-asset class data mortgage technology, comprehensive digital workflow tools for the U.S. residential mortgage market lifecycle. These services are offered to financial institutions, corporations, government entities, and other organizations in several countries including the US, UK, EU, India, Israel, Canada, and Singapore. The Intercontinental Exchange, Inc. ICE stock has experienced a significant decline of over 21% in the past year, despite several positive financial results and strategic acquisitions. The company reported strong earnings reports, including a 16% year-over-year increase in consolidated net revenues and record revenues for its mortgage technology and data businesses. Additionally, ICE made strategic investments and acquisitions, such as acquiring AFX and committing up to $2 billion in Polymarket. However, several negative news items and market factors have contributed to the decline. JP Morgan lowered its price target for ICE to $180 from $202, citing reduced expectations for IMT revenues and adjustments for interest expense related to commercial paper drawdown for Polymarket. The company's stock was also trading near its 52-week low in late October 2025, indicating sustained downward pressure. Furthermore, some analysts downgraded ICE, including Deutsche Bank downgrading it to hold from buy in August 2024, and Raymond James downgrading it to outperform from strong buy in October 2024. The high implied volatility in the options market also suggested that the market expected a significant price movement, amplifying concerns about potential downside. Overall, while ICE has reported strong financial results and made strategic investments, the negative news items and market factors have outweighed these positives, contributing to the stock's decline of over 21% in the past year. The primary drivers of revenue growth or decline in this financial summary can be summarized as follows. Revenue growth is primarily driven by increased volumes and volatility in various markets. Specifically, the growth in cash and cash equivalent margin deposits and guarantee funds, exchanges revenue, and cash equities and equity options are key contributors to revenue growth. Additionally, higher industry volumes driven by geopolitical risks and higher retail participation have also contributed to revenue growth. On the other hand, revenue decline is primarily due to lower volumes traded in certain asset classes, such as agricultural and metals futures and options, and lower equity market volatility, affecting other financial futures and options. Furthermore, a decrease in Section 31 fees due to lower rates has also contributed to revenue decline. Overall, market volatility, industry volumes, and geopolitical risks have been the primary drivers of revenue growth or decline in this financial summary. Net income and profit margins experienced significant changes between 2024 and 2025. Net income increased by $415 million, from $3.1 billion to $3.5 billion, indicating a substantial growth. Profit margins also improved, with operating income margin rising from 34.6% in 2024 to 36.3% in 2025. The increase in net income and profit margins can be attributed to several factors. Data and analytics revenues saw significant growth due to the continued adoption of data solutions and increased purchases by existing customers. Additionally, higher exchange segment revenues contributed to the overall improvement. However, a one-time gain related to the PennyMac arbitration final award payment recorded in 2024 partially offset these gains. Despite some fluctuations, net income and profit margins demonstrated a clear upward trend between 2024 and 2025. The growth can be attributed to the company's ability to adapt to changing market conditions and capitalize on emerging opportunities. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from various sections of the report confirms this trend. For instance, on page 14, it is stated that net cash provided by operating activities for both 2025 and 2024 were positive at $3,387 million and $3,103 million respectively. Similarly, page 51 highlights a 9% increase in cash flows from operating activities to $3,387 million, accompanied by a corresponding rise in free cash flow to $2,862 million. The summary of operating activities on page 75 shows a net increase in cash and cash equivalents of $1,318 million for 2025. Furthermore, the operating cash flow for the 9 months ended September 30, 2025 was $831 million, which is higher than the $780 million recorded for the same period in 2024. These figures collectively demonstrate that the company has been able to generate positive operating cash flow consistently over the past 2 years. The company's debt level has undergone significant changes between 2024 and 2025. While total liabilities increased by $484 million initially, the overall debt level decreased by a substantial 8.3%, or minus $7.9 billion. Furthermore, the debt level rose from $16.2 billion in 2024 to $19 billion in 2025, indicating an increase of approximately $2.8 billion. In terms of interest expenses, there has been a notable decrease. Interest expense dropped by 14.1% for the 9 months ended September 30, 2025 compared to 2024, and also decreased by minus 11% from $659 million to $583 million in 2025 compared to 2024. The conflicting information across multiple pages highlights the complexity of the company's financial situation. However, it is clear that there has been a significant change in both debt level and interest expenses between 2024 and 2025. The company's financial performance varied across different segments and regions. The exchanges segment performed well, with increased revenues and operating income in both the 9-month and 3-month periods. Fixed income and data services also showed strong growth, with a 13% increase in revenues for the 9 months ended September 30, 2025. In contrast, several segments underperformed. The mortgage technology segment had low operating income in the 9-month period, while agricultural and metals futures and options saw a significant decline of 11% in the 9-month period. OTC and other also experienced a decrease in revenues, with a 5% drop in the 9-month period. The energy futures and options segment showed moderate growth, with a 17% increase in the 9-month period. Cash equities and equity options business saw an increase of 16% in the 9-month period, but declined by 11% in the 3-month period. Data and connectivity services also experienced growth, with a 7% increase in the 9-month period. Overall, while some segments performed well, others struggled to meet expectations. The company will need to address these underperforming areas to achieve overall financial success. Management is expressing caution regarding the company's outlook due to external factors such as global financial market conditions, economic and social changes, interest rates, inflation, tariffs, trade policies, market volatility, and geopolitical events. However, they are focused on mitigating risks through strategic acquisitions and investments. To achieve this, the company aims to minimize jurisdictional risks, realize benefits from existing deals, and pursue new opportunities for growth. Financially, management plans to maintain a strong balance sheet by leveraging cash flows and prioritizing debt reduction when necessary. In terms of strategy, the company is committed to exploring potential acquisitions and investments to strengthen its competitive position and support growth initiatives. This includes adopting a quarterly dividend declaration policy to align with evolving business models and strategic objectives. The company has a history of distributing value to its shareholders through both dividend payments and share buybacks. In recent years, the company paid out significant amounts in dividends, with $831 million and $276 million distributed in 2025, and $780 million and $261 million in 2024. Additionally, the company has also engaged in share buybacks, with a total of $894 million spent on buying back shares in 2025. That concludes the financial summary for Intercontinental Exchange Inc. Feel free to comment below, and I will be happy to answer them when possible.